Question 1. An applicant for a life insurance policy in California misstates her age on the application. If the error is discovered after the policy has been issued and the insured dies, what will the insurer typically do? A. Deny the claim and refund all premiums paid. B. Pay the death benefit amount that the premium paid would have purchased at the correct age. C. Pay the full face amount but assess a penalty against the beneficiary. D. Void the policy from its inception due to material misrepresentation. Answer: B. Pay the death benefit amount that the premium paid would have purchased at the correct age. The misstatement of age or sex provision states that if an insured's age or sex has been misstated, the insurer will adjust the death benefit to an amount that the premium paid would have purchased at the correct age or sex. This provision ensures that neither the insurer nor the insured is unfairly disadvantaged by an honest mistake, allowing the contract to remain in force. It's a standard policy clause that prevents the insurer from voiding the policy solely due to an innocent misrepresentation of age or gender. This adjustment ensures fairness by providing the coverage the insured actually paid for based on accurate demographic information. Question 2. What is the primary purpose of the California Insurance Code's free look provision for life insurance policies? A. To allow the insurer to re-evaluate the policyholder's insurability after issue. B. To permit the policy owner to surrender the policy for its cash value at any time without penalty. C. To give the policy owner a specified period to review the policy and return it for a full refund. D. To enable the policy owner to make changes to the policy's beneficiaries within the first 30 days. Answer: C. To give the policy owner a specified period to review the policy and return it for a full refund. The free look provision, also known as the right to examine period, allows a policy owner to review their newly purchased life insurance policy and, if dissatisfied for any reason, return it to the insurer for a full refund of premiums paid. In California, this period is generally 10 days, but for policies sold to seniors, age 60 or older, it extends to 30 days. This consumer protection ensures that individuals have ample time to confirm the policy meets their needs before committing to the long-term contract. It's a crucial safeguard that prevents consumers from being locked into a policy they don't understand or want. Question 3. Under a life insurance policy in California, if the insured dies during the grace period without having paid the premium, what will the insurer typically do? A. Deny the claim because the premium was not paid. B. Pay the full death benefit and waive the unpaid premium. C. Subtract the unpaid premium from the death benefit paid to the beneficiary. D. Reinstate the policy only after all past due premiums are paid by the beneficiary. Answer: C. Subtract the unpaid premium from the death benefit paid to the beneficiary. The grace period is a specified length of time, typically 30 or 31 days in California, after a premium payment is due, during which the policy remains in force and the insured can still pay the premium without the policy lapsing. If the insured dies during this period, the insurer will pay the death benefit, but they will deduct the unpaid premium from the payout. This ensures the beneficiary still receives the intended protection while allowing the insurer to recover the premium owed. It's a key provision protecting policy owners from immediate lapse due to a slight delay in payment. Question 4. Which of the following statements about the incontestability clause in a California life insurance policy is true? A. It allows the insurer to contest a claim at any time if fraud was committed in the application. B. It prevents the insurer from denying a claim based on misrepresentations in the application after a specified period, usually 2 years. C. It requires the policy owner to prove their insurability each year for the policy to remain in force. D. It dictates that the death benefit amount is subject to renegotiation after the policy has been in force for 5 years. Answer: B. It prevents the insurer from denying a claim based on misrepresentations in the application after a specified period, usually 2 years. The incontestability clause in a life insurance policy, typically 2 years in California, states that after the policy has been in force for this period, the insurer cannot deny a claim based on any misstatements or concealment of facts in the original application, even if they were material. The primary exception is if fraud was committed with the intent to deceive. This clause provides assurance to policyholders that their beneficiaries will receive the death benefit without the insurer later attempting to void the policy due to application errors. It creates a period during which the insurer can investigate, but after that, the policy becomes incontestable. Question 5. In California, which of the following is considered an unfair trade practice known as twisting? A. Accepting a premium payment in cash without providing a receipt. B. Replacing an existing life insurance policy with a new one based on misrepresentation or incomplete comparison. C. Charging different premium rates for individuals of the same actuarial risk class. D. Making false statements about the financial condition of an insurer. Answer: B. Replacing an existing life insurance policy with a new one based on misrepresentation or incomplete comparison. Twisting is an unfair trade practice specifically prohibited in California where an agent persuades a policy owner to drop an existing life insurance policy and replace it with a new one, to the policy owner's detriment, by using misrepresentations or an incomplete comparison of the policies. This unethical practice often results in the policyholder losing valuable benefits, such as a lower premium rate on the old policy or a higher cash value. California law requires agents to provide a notice regarding replacement to inform policy owners of the potential disadvantages when considering a replacement. Question 6. A life insurance policy in California offers a lump sum payment to the beneficiary upon the death of the insured. This policy is most likely what type? A. An annuity. B. A disability income policy. C. A whole life insurance policy. D. A long-term care policy. Answer: C. A whole life insurance policy. A whole life insurance policy is a type of permanent life insurance that provides coverage for the entire lifetime of the insured, as long as premiums are paid. Its primary benefit is a guaranteed death benefit paid as a lump sum to the designated beneficiary upon the insured's death. Unlike annuities, which provide income during retirement, or disability and long-term care policies, which cover specific health-related events, whole life insurance's core purpose is to provide financial protection to loved ones after the insured's passing. This makes it a foundational tool for estate planning and financial security. Question 7. What type of life insurance policy is characterized by a level death benefit, level premiums, and guaranteed cash value growth that endures for the insured's entire life? A. Annually renewable term. B. Universal life. C. Whole life. D. Variable life. Answer: C. Whole life. Whole life insurance is a type of permanent life insurance that offers a combination of features: a death benefit that remains level throughout the insured's life, premiums that are fixed and remain constant, and a guaranteed cash value component that grows steadily over time on a tax-deferred basis. This predictability makes it a stable financial tool for long-term protection and savings. Unlike term insurance, which covers a specific period, or flexible universal and variable life policies, whole life provides lifelong, predictable coverage and cash accumulation. Question 8. In California, what is the primary distinction between a revocable and an irrevocable beneficiary designation? A. A revocable beneficiary receives a larger death benefit than an irrevocable one. B. A revocable beneficiary cannot be changed by the policy owner, while an irrevocable one can. C. An irrevocable beneficiary must consent to any change in beneficiary or policy assignment, while a revocable one does not. D. A revocable beneficiary automatically receives the death benefit, whereas an irrevocable beneficiary must file a claim. Answer: C. An irrevocable beneficiary must consent to any change in beneficiary or policy assignment, while a revocable one does not. The key distinction between revocable and irrevocable beneficiaries lies in the policy owner's ability to change the designation. A revocable beneficiary can be changed at any time by the policy owner without their consent. Conversely, an irrevocable beneficiary has a vested interest in the policy, meaning the policy owner cannot change the beneficiary, borrow against the cash value, or assign the policy without the irrevocable beneficiary's written consent. This protection makes an irrevocable designation a stronger, more permanent commitment to the beneficiary's interest. Question 9. An agent helps a client purchase a variable life insurance policy. Which statement is true regarding the agent's licensing requirements in California? A. The agent only needs a California life-only agent license. B. The agent needs a California life-only agent license and a FINRA securities license. C. The agent needs only a FINRA securities license, not an insurance license. D. The agent needs a California property and casualty license, plus a securities license. Answer: B. The agent needs a California life-only agent license and a FINRA securities license. Variable life insurance policies are considered both insurance products and securities products because their cash value is invested in a separate account whose performance fluctuates based on the underlying investments, and there are no guarantees. Due to this dual nature, an agent selling variable life policies in California must hold both a valid California life-only agent license, issued by the Department of Insurance, and a valid securities registration, FINRA license, typically Series 6 or 7, issued by the Financial Industry Regulatory Authority. This dual licensing ensures the agent is qualified to explain both the insurance and investment aspects of the product. Question 10. A policy owner in California surrenders their whole life insurance policy for its cash value. What is the tax implication of the amount received? A. The entire cash value received is taxable as ordinary income. B. The cash value received is entirely tax-free. C. Only the amount received in excess of the premiums paid, cost basis, is taxable as ordinary income. D. The cash value received is subject to capital gains tax. Answer: C. Only the amount received in excess of the premiums paid, cost basis, is taxable as ordinary income. When a whole life insurance policy is surrendered for its cash value, the amount received that exceeds the total premiums paid into the policy, known as the policy's cost basis, is considered taxable income. This excess amount is taxed as ordinary income, not capital gains. The portion of the cash value that represents the return of the policy owner's premiums is received tax-free. This rule encourages policy owners to keep their policies, as the growth within the policy is tax-deferred until surrender. Question 11. Which life insurance rider provides for a waiver of premium if the insured becomes totally disabled? A. Accidental death benefit rider. B. Guaranteed insurability rider. C. Cost of living rider. D. Waiver of premium rider. Answer: D. Waiver of premium rider. The waiver of premium rider is an optional addition to a life insurance policy that ensures the policy remains in force even if the insured becomes totally disabled and is unable to pay premiums. If the insured meets the definition of total disability specified in the policy, the insurer will waive future premium payments for the duration of the disability, without affecting the policy's benefits or cash value growth. This rider provides crucial financial protection, preventing a policy from lapsing due to an unforeseen loss of income. Question 12. In California, if an insurer wishes to use HIV testing as part of its underwriting process for a life insurance application, what must it obtain from the applicant? A. Only verbal consent is required. B. Written informed consent specifically for HIV testing. C. Written consent for a general medical exam, which implicitly includes HIV testing. D. No specific consent is needed if the applicant signs the application. Answer: B. Written informed consent specifically for HIV testing. In California, insurers are permitted to require HIV testing for life insurance underwriting, but strict regulations are in place to protect applicant privacy. The insurer must obtain the applicant's specific written informed consent for the HIV test, detailing what the test is for, how the results will be used, and who will receive the results. This explicit consent ensures applicants are fully aware of and agree to the testing process before it occurs, emphasizing the sensitive nature of HIV status. Question 13. Which of the following is not considered a non-forfeiture option in a whole life insurance policy? A. Cash surrender value. B. Extended term option. C. Reduced paid-up option. D. 1-year term option. Answer: D. 1-year term option. Non-forfeiture options are provisions in whole life insurance policies that protect the policy owner's cash value if they stop paying premiums. The three standard non-forfeiture options are cash surrender value, taking the accumulated cash as a lump sum, extended term option, using the cash value to buy a single premium term policy for the same death benefit amount for a limited time, and reduced paid-up option, using the cash value to buy a lower face amount of permanent, paid-up insurance. The 1-year term option is typically a dividend option, where policy dividends are used to purchase a 1-year term policy. Question 14. A policy owner purchases a life insurance policy and names her sister as the primary beneficiary and her brother as the contingent beneficiary. If the policy owner and her sister die simultaneously, who will receive the death benefit? A. The policy owner's estate. B. The contingent beneficiary, the brother. C. The policy owner's next of kin as determined by state law. D. The insurer retains the death benefit. Answer: B. The contingent beneficiary, the brother. A contingent beneficiary is designated to receive the death benefit if the primary beneficiary predeceases the insured or, in this case, dies simultaneously with the insured. Since the primary beneficiary, the sister, cannot receive the proceeds due to simultaneous death, the death benefit will then be paid to the contingent beneficiary, the brother. This designation ensures a clear path for the death benefit payout and avoids the proceeds being paid into the insured's estate, which could lead to probate delays. Question 15. What is the maximum duration of a temporary life insurance license in California? A. 6 months. B. 9 months. C. 12 months. D. 24 months. Answer: A. 6 months. In California, a temporary life insurance license may be issued for a maximum period of 6 months. This temporary license allows an individual to begin working as an agent under the supervision of a sponsoring insurer while they prepare for and pass the required licensing exam. It's designed to provide a limited operational period for new agents to gain experience before obtaining their full, permanent license. The temporary license cannot be renewed or reissued to the same person. Question 16. A policy owner in California wants to assign ownership of their life insurance policy to a bank as collateral for a loan. What type of assignment is this? A. Absolute assignment. B. Collateral assignment. C. Irrevocable assignment. D. Vested assignment. Answer: B. Collateral assignment. A collateral assignment is a type of assignment where the policy owner transfers only some of their rights in the policy to a third party, typically a bank, as security for a debt or loan. In this scenario, the bank only has rights to the portion of the death benefit equal to the outstanding loan balance. Once the loan is repaid, the bank's interest in the policy is terminated, and full ownership rights revert to the original policy owner. This differs from an absolute assignment, which transfers all rights of ownership permanently. Question 17. Which statement accurately describes the tax treatment of the death benefit paid to a beneficiary from a life insurance policy in California? A. It is generally taxable as ordinary income to the beneficiary. B. It is generally taxable as a capital gain to the beneficiary. C. It is generally received income tax-free by the beneficiary. D. It is subject to estate tax for the beneficiary. Answer: C. It is generally received income tax-free by the beneficiary. One of the most significant advantages of life insurance is that the death benefit paid to a named beneficiary is generally received free of federal and state income tax. This means that the full face amount of the policy is available to the beneficiaries without any portion being withheld for income tax purposes. While it may be included in the insured's gross estate for estate tax purposes if the insured retained incidents of ownership, the direct receipt by the beneficiary is income tax exempt. Question 18. What is the primary purpose of the Medical Information Bureau, MIB, in life insurance underwriting? A. To conduct physical examinations for applicants. B. To provide a central repository of medical information for underwriting purposes, helping to detect fraud and misrepresentation. C. To offer medical treatment to insureds. D. To set standard medical premium rates for all insurers. Answer: B. To provide a central repository of medical information for underwriting purposes, helping to detect fraud and misrepresentation. The Medical Information Bureau, MIB, is a non-profit trade organization that maintains a database of health information on individuals who have applied for life and health insurance. Its primary purpose is to serve as an information exchange for member insurance companies, helping them detect fraud and misrepresentation by applicants and reducing adverse selection. When an applicant applies for insurance, the insurer can check the MIB to see if the applicant previously reported any health conditions to other member companies, ensuring consistency and accuracy in the underwriting process. Question 19. An insured in California has a life insurance policy with a guaranteed insurability rider. What benefit does this rider provide? A. It guarantees the policy will never lapse due to non-payment of premiums. B. It allows the insured to purchase additional insurance at specified future dates without proof of insurability. C. It guarantees the policy's cash value will grow at a fixed, high rate. D. It provides a payout if the insured becomes terminally ill. Answer: B. It allows the insured to purchase additional insurance at specified future dates without proof of insurability. The Guaranteed Insurability Rider is a valuable addition to a life insurance policy, particularly for younger individuals. It grants the policy owner the right to purchase additional amounts of life insurance coverage at predetermined future dates or specific life events, like marriage or birth of a child, without having to prove their insurability. This means that even if the insured's health declines, they can still acquire more coverage, ensuring their growing financial needs are met regardless of their health status. Question 20. When an existing life insurance policy is replaced with a new one in California, what is the producer's responsibility regarding the notice regarding replacement? A. The producer must advise the policy owner verbally that a replacement is occurring. B. The producer must provide the policy owner with a written notice regarding replacement and submit a copy to the replacing insurer. C. The producer is not required to provide any notice, as it is the insurer's responsibility. D. The producer must only inform the existing insurer of the replacement. Answer: B. The producer must provide the policy owner with a written notice regarding replacement and submit a copy to the replacing insurer. In California, strict regulations govern the replacement of life insurance policies to protect consumers. When a producer facilitates a replacement, they are legally required to provide the applicant with a written notice regarding replacement at the time of the application. This notice informs the applicant of potential disadvantages of replacement, such as new contestability periods or surrender charges, and advises them to carefully compare the policies. A copy of this notice must also be submitted to the replacing insurer, and usually to the existing insurer as well, ensuring transparency in the transaction. Question 21. Which type of life insurance policy is also known as permanent insurance and builds cash value over the life of the policy? A. Term life. B. Mortgage protection insurance. C. Whole life. D. Credit life. Answer: C. Whole life. Whole life insurance is commonly referred to as permanent insurance because it provides coverage for the insured's entire lifetime, unlike term life insurance which covers a specific period. A defining characteristic of whole life is its cash value component, which accumulates over time on a tax-deferred basis. This cash value can be accessed by the policy owner through policy loans or withdrawals, or it can be surrendered for its cash value. Term, mortgage protection, and credit life are all forms of temporary insurance and do not build cash value. Question 22. In California, what is the maximum length of time for the suicide clause in a life insurance policy? A. 6 months. B. 1 year. C. 2 years. D. 3 years. Answer: C. 2 years. The suicide clause in a life insurance policy states that if the insured commits suicide within a specified period from the policy's issue date, the insurer will only return the premiums paid, without interest, and will not pay the death benefit. In California, this period is typically limited to 2 years. If the insured commits suicide after this 2-year period, the full death benefit will be paid to the beneficiary. This clause is designed to protect insurers from individuals purchasing policies with the intent to commit suicide immediately. Question 23. An individual living in California is considering purchasing an annuity. Which characteristic best describes an annuity? A. It provides a death benefit to a beneficiary upon the insured's death. B. It is primarily designed to accumulate funds and then provide a stream of income during retirement. C. It offers a guaranteed return on investment with no risk. D. It is a temporary insurance policy that covers a specific period. Answer: B. It is primarily designed to accumulate funds and then provide a stream of income during retirement. An annuity is a financial contract designed to accumulate funds, typically over a period of years, and then provide a series of periodic payments to an individual, usually during their retirement or for a specified duration. While some annuities have death benefit features, their primary purpose is income distribution, making them distinct from life insurance policies whose main purpose is to provide a death benefit. Annuities are used to manage the risk of outliving one's savings, providing a steady income stream for life. Question 24. What is the main difference between participating and non-participating life insurance policies? A. Participating policies are sold by mutual companies, while non-participating policies are sold by stock companies. B. Participating policies pay dividends to the policy owner, while non-participating policies do not. C. Participating policies have a guaranteed cash value, while non-participating policies do not. D. Participating policies are always more expensive than non-participating policies. Answer: B. Participating policies pay dividends to the policy owner, while non-participating policies do not. The core difference between participating and non-participating life insurance policies lies in the payment of dividends. Participating policies, typically issued by mutual insurance companies, allow policy owners to participate in the company's surplus by receiving non-guaranteed dividends. These dividends are a return of unneeded premiums and can be used in several ways, example cash, premium reduction, paid-up additions. Non-participating policies, usually issued by stock companies, do not pay dividends, their premiums are generally lower from the outset. Question 25. Which of the following statements about group life insurance in California is generally true? A. Individual participants receive individual policies and pay separate premiums. B. The employer is typically the policy owner, and the employees are the insureds. C. Proof of insurability is always required for each individual member of the group. D. It provides a higher death benefit than comparable individual policies. Answer: B. The employer is typically the policy owner, and the employees are the insureds. In group life insurance, a single master policy is issued to the group sponsor, such as an employer, union, or association, making the sponsor the policy owner. The individuals covered under this master policy, typically employees or members, are the insureds and receive certificates of insurance rather than individual policies. A key advantage of group life is that it often requires little to no individual underwriting, meaning proof of insurability is generally not required for most members, especially if they enroll during the initial eligibility period.